All right, crypto fam, buckle up because the market is absolutely exploding with news, and you need to know what's happening. We're talking about seismic shifts, unexpected moves, and predictions that will blow your mind. Get ready for the hottest takes and the deepest dives, because here at Bitcoin Bulletin, we're cutting through the noise to bring you the essential updates that are shaping the future of digital assets. The pace is relentless, the action is nonstop, and if you miss this, you're missing out on the biggest stories in the game. Don't get left behind, stay ahead of the curve with us. First up, we've got a bombshell from none other than JPMorgan, dropping a valuation on Bitcoin that's going to make some heads spin. Is the biggest digital asset in the world massively undervalued? JPMorgan seems to think so, and their reasoning could unlock a whole new level of institutional interest. We're diving deep into the numbers that suggest Bitcoin's fair value is astronomically higher than where it's trading now, and what's driving this incredible reassessment. You won't want to miss this analysis. Then, get ready for some whiplash as we unpack a seemingly contradictory move from Tether. They're shouting about bringing USDT back to Bitcoin, but here's the kicker. They're simultaneously pulling the plug on support for the very same Bitcoin networks they've relied on for years. We'll break down this strategic pivot, what it means for USDT on Bitcoin, and why this announcement is raising more than a few eyebrows. It's a complex story, and we've got the full breakdown. Next, we're shifting gears to look at a chart that's painting a picture of explosive potential for Solana. Could a rare technical pattern be signaling a massive breakout for Sol against Bitcoin? We're talking about historical precedents that have led to gains of over 1,000%. Plus, we'll explore the fundamental factors, including new treasury buys, that are stacking the odds in Solana's favor for a significant rally. Is $300 on the horizon? We're breaking it all down. And finally, we're circling back to JPMorgan for another perspective, this time on Bitcoin's volatility and its appeal to the big players. They're saying Bitcoin is becoming less of a wild ride, which could be the key to unlocking even more mainstream adoption. What does this mean for the average investor and the future of Bitcoin as a stable store of value? We've got all the insights you need. Stick around because this is the Bitcoin Bulletin, and we're diving in right now. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. Bitcoin's fair value skyrockets. JPMorgan predicts $126,000 target. JPMorgan analysts have issued a bold new valuation for Bitcoin, suggesting the cryptocurrency is significantly undervalued and could reach a fair value of $126,000 by the end of the year. This eye-opening prediction stems from a notable decrease in Bitcoin's price volatility, which has fallen to historic lows, effectively narrowing the risk-adjusted gap between Bitcoin and traditional safe haven assets like gold. Bitcoin's volatility has seen a dramatic decline, dropping from nearly 60% at the start of the year to approximately 30%, marking the lowest level ever recorded. Analysts at JPMorgan, led by Nikolaos Panagurtsoglou, interpret this trend as a strong indicator of Bitcoin's maturing market. They posit that this reduced volatility makes Bitcoin a more attractive asset for institutional investors, who often shy away from highly volatile instruments. The report, shared by the block, highlights that this decreasing volatility is a key factor, supporting their $126,000 fair value estimate. A significant contributor to this phenomenon is the increasing adoption of Bitcoin by corporate treasuries. Currently, corporations hold over 6% of Bitcoin's total supply, a trend that JPMorgan compares to the post-2008 financial crisis era in the bond market. During that period, central bank quantitative easing policies dampened market swings by absorbing assets into balance sheets, similar to how corporate Bitcoin holdings are now stabilizing the market. Furthermore, the growing inclusion of Bitcoin-related assets in major equity indices, such as MSTR's addition to key benchmarks and metaplanets, MTPLF, upgrade to mid-cap status impacting its inclusion in the FTSE All-World Index, is fueling new allocations from institutional investors seeking exposure to digital assets. This increased institutional interest is intensifying competition among corporate treasuries looking to adopt Bitcoin. Companies like KindlyMD and AKA, listed on Nasdaq, are filing to raise substantial amounts, up to $5 billion, specifically naming Bitcoin as their reserve asset. Additionally, Atom-Bax BSDR is reportedly aiming to become the second-largest corporate holder of Bitcoin, trailing only MicroStrategy. These developments, including strong treasury demand and index-driven inflows, coupled with declining volatility, significantly strengthen Bitcoin's investment profile. Lower volatility inherently makes it easier for institutions to allocate risk capital, positioning Bitcoin as a more comparable asset to gold within diversified portfolios. The ratio of Bitcoin's volatility to gold's volatility has fallen to its lowest point ever, currently at 2. JPMorgan estimates that Bitcoin's current $2.2 trillion market capitalization would need to increase by approximately 13% to reach $126,000, aligning it with the $5 trillion private gold market. They noted that at the end of 2024, Bitcoin was trading $36,000 above this calculated fair value, whereas it is now approximately $13,000 below it, clearly indicating substantial potential upside. Will this JPMorgan assessment trigger a new wave of institutional adoption? Next, we're looking at a surprising shift from Tether that has the crypto world talking. Tether's conflicting signals, ending Bitcoin support while announcing new integrations. In a move that has generated considerable confusion and debate within the cryptocurrency community, stablecoin giant Tether has announced plans to terminate support for its largest Bitcoin-based token, USDT, on the Omni layer, while simultaneously promoting new integrations with Bitcoin's Lightning Network protocols. This apparent contradiction raises questions about Tether's long-term strategy and its commitment to the Bitcoin ecosystem. On July 11th, Tether officially stated that as part of a strategic infrastructure review, it would cease support for USDT on the Omni layer, its oldest and most utilized Bitcoin-based token, effective September 1, 2025. The company cited that the Omni layer was not high-utility, actively developed infrastructure that aligned with community usage trends compared to other blockchains where Tether continues to offer support. Following this date, redemptions of USDT on Omni will stop, and existing tokens will be manually frozen by Tether. This decision marks the end of over a decade of Tether's support for the Omni layer, which began around October 2014. The only remaining USDT on Bitcoin tokens will be those on Blockstream's Liquid sidechain, representing less than $50 million in value. However, on the same morning of this announcement, Tether also proudly declared its excitement to bring USDT home to Bitcoin via 2 new protocols on the Bitcoin Lightning Network, Taproot Assets and RGB. This marketing push, focusing on future integrations, conspicuously omitted the critical detail about the impending termination of support for the Omni layer, its most significant Bitcoin integration. This dual messaging strategy has led to accusations of doublespeak within the community. Notably, Tether has a history of regulatory scrutiny regarding its token backing. Its chief financial officer previously signed a settlement agreeing never to deny that, from June 1 to September 15, 2017, USDT tokens were not backed one-to-one by USD held in reserve, despite claims to the contrary at the time. Furthermore, Tether paid the Commodity Futures Trading Commission, CFTC, $41 million over allegations of inconsistently backing its USDT. The decision to discontinue support for Omni, EOS, Algorand, SLP, and Kusama while exploring Layer 2 solutions on Bitcoin highlights a strategic shift. Tether currently supports fiat redemption on a wide array of blockchains, including Tron, Ethereum, Solana, Aptos, Ton, Avalanche, Celo, Cosmos, Omni, Kaya, Near, Liquid, Tezos, Polkadot Asset Hub, EOS, SLP, Algorand, and Kusama Asset Hub. The simultaneous announcement of ending support for some of these older or less utilized networks, while pushing for new, more modern integrations on Bitcoin, signals a move towards consolidating resources and focusing on protocols deemed more aligned with current market trends and technological advancements. This strategic consolidation aims to streamline operations and enhance the utility and stability of USDT across fewer, more robust platforms. This conflicting announcement from Tether is certainly raising eyebrows across the crypto space. Now, let's turn our attention to a chart that might be predicting a massive surge for Solana. Solana's Golden Cross, technical pattern hints at explosive breakout to $300 against Bitcoin. A significant technical indicator is flashing a bullish signal for Solana SOL against Bitcoin BTC, suggesting a potential for substantial price appreciation. The SOL BTC trading pair is on the verge of completing a rare golden cross, a bullish chart pattern that has historically preceded massive rallies for both cryptocurrencies. This development, combined with a favorable altcoin market backdrop and significant new treasury inflows, paints a compelling picture for Solana's upside potential, with analysts eyeing a potential target of $300. The golden cross occurs when a short-term moving average, typically the 50-day, crosses above a long-term moving average, typically the 200-day. As of Thursday, Solana's 50-day simple moving average, SMA, was on track to surpass its 200-day SMA, confirming this bullish pattern. Analyst Rand Neuner highlighted the historical significance of this setup, noting its appearance in 2021 and 2023, and stated that the current pattern is screaming for a major move in SOL. Previous instances of the SOL BTC Golden Cross have been followed by extraordinary gains. In early 2021, the first Golden Cross preceded a roughly 1,900% rally for SOL against BTC. The second Golden Cross in mid-2023 resulted in a similar outcome. Critically, these SOL BTC rallies have historically coincided with significant uptrends in the SOL USD pair. Following the 2021 Golden Cross, Solana's price surged by approximately 1,890%, moving from $13 to over $260. Similarly, after the 2023 Golden Cross, SOL climbed over 1,000%, from around $20 to above $250. These powerful rallies in both SOL BTC and SOL USD have often occurred during periods of altseason, characterized by capital rotation from Bitcoin into higher beta altcoins. In 2021, Solana's breakout coincided with the DeFi boom, benefiting the entire altcoin market. The 2023 rally followed a similar pattern, fueled by recovery liquidity post-FTX. The current market environment appears equally supportive. Ethereum, ETH, has already shown strength relative to Bitcoin, often considered an early indicator of an impending altseason. Furthermore, historical Bitcoin halving cycles suggest that liquidity expansion and capital rotation typically accelerate in the year following a halving event, a trend that could benefit Solana significantly. Beyond the technicals, Solana's fundamental outlook is bolstered by increasing demand from institutional players. Recent reports indicate that major firms like Galaxy Digital, Jump Crypto, and Multicoin Capital are planning to raise over $1 billion for a Solana treasury fund, backed by the Solana Foundation. Additionally, Sharps Technology has committed $400 million to its Solana reserves, and Pantra Capital is actively pursuing a $1.25 billion Solana-focused investment vehicle. Collectively, these initiatives represent nearly $3 billion in potential new demand for Solana, which could further propel its price towards the $300 mark in the coming weeks. Solana is also trading within a broadening wedge, or megaphone pattern, with its upper trendline pointing towards resistance in the $295-300 zone by October. The asset remains comfortably above its 50-week and 200-week exponential moving averages, EMAs, and its weekly relative strength index, RSI, remains bullish at 61, indicating sustained upward momentum. These technical and fundamental factors create a compelling case for Solana's potential growth. Now, let's revisit JPMorgan for a different take on Bitcoin's evolving market position. JPMorgan, Bitcoin's diminishing volatility attracts big investors. JPMorgan analysts are signaling a significant shift in Bitcoin's perception among major investors, suggesting that its decreasing volatility is making the cryptocurrency more palatable for large-scale adoption. This evolving characteristic is seen as a key factor that will encourage greater comfort and confidence among institutional players looking to allocate capital into digital assets. The analysis from JPMorgan indicates that Bitcoin is shedding its reputation as an excessively volatile asset, a trait that has historically deterred many risk-averse institutional investors. As Bitcoin's price swings become more moderate, it increasingly resembles traditional financial assets in terms of risk profile. This trend is crucial for Bitcoin's journey towards becoming a mainstream store of value and a widely accepted investment class. The decreasing volatility is not just a statistical anomaly. It reflects a maturing market, increased liquidity, and growing adoption by both retail and, increasingly, institutional participants. This development is closely tied to the broader trend of corporate treasuries acquiring Bitcoin, a phenomenon that JPMorgan has previously highlighted. When corporations hold significant amounts of Bitcoin on their balance sheets, it tends to stabilize the market by reducing the circulating supply available for speculative trading. This provides a grounding effect on price action, making it less susceptible to extreme fluctuations. Furthermore, the integration of Bitcoin into various financial products and indices, as mentioned in previous analyses, also contributes to this stability. As Bitcoin becomes embedded in more traditional investment vehicles, its price movements tend to align more closely with broader market trends, further reducing its perceived idiosyncratic risk. The implication of this reduced volatility is profound for institutional adoption. Large asset managers, pension funds, and endowments typically have mandates that require them to maintain certain risk-adjusted return profiles. Assets with extremely high volatility, even with the potential for high returns, can be difficult to fit within these frameworks. By becoming less volatile, Bitcoin becomes a more viable candidate for diversification within institutional portfolios. It can potentially offer exposure to a high-growth asset class without introducing an unacceptable level of risk. This makes it easier for compliance departments and investment committees to approve allocations, paving the way for larger capital inflows. JPMorgan's commentary suggests that the market is reaching an inflection point where Bitcoin's risk characteristics are becoming more aligned with those of traditional assets like gold or even certain equities. This convergence in risk profiles is expected to unlock significant demand from investors who have been on the sidelines, waiting for Bitcoin to mature. As more of these large investors gain comfort, the demand for Bitcoin is likely to increase, potentially driving up its price and further solidifying its position as a legitimate asset class. The narrative is shifting from Bitcoin as a speculative bet to Bitcoin as a strategic asset, a transition that is crucial for its long-term growth and stability. This evolving perception of Bitcoin's stability is a game changer for institutional investment. Now, let's wrap up all the major stories we covered today and what they mean for you. And that's a wrap on today's essential market updates. We saw JPMorgan pegging Bitcoin's fair value at a staggering $126,000 due to its decreasing volatility. Then, Tether dropped a bombshell, ending support for its oldest Bitcoin token while announcing new Lightning Network integrations, a move causing quite a stir. We also highlighted a bullish golden cross pattern for Solana against Bitcoin, potentially signaling a breakout to $300, backed by strong institutional interest. Finally, JPMorgan reiterated that Bitcoin's reduced volatility is making it more attractive to big investors, paving the way for greater adoption. Don't miss out on any future updates. Hit that like button if you found this valuable, subscribe to Bitcoin Bulletin for your daily dose of crypto intelligence, and ring that notification bell so you're always the first to know. Share your thoughts in the comments below, and make sure to follow us on all our social channels for real-time insights and discussions. Thanks for watching, and we'll see you in the next one.